Welcome to the deep dive. Okay, so forget the usual market jargon today. We're diving into something much more personal.
Yeah, we're talking about the psychology behind, well, pretty much every single money decision we make.
Exactly. And you're here because you want to really get this stuff right without getting totally lost in spreadsheets and formulas. And, well, that's what we're going to try and do.
Our mission, you could say, is to sort of uncover how your unique life experiences, your history, really shape your financial views and ultimately the choices you make.
We've pulled together some really interesting pieces, research stories, some surprising facts to maybe shed some light on this connection, between our lives and our money.
It's a powerful connection, often more powerful than we think.
Okay, so let's kick things off with a story that honestly really stopped me in my tracks. Have you heard of Ronald Reed?
Vaguely, the name sounds familiar, the janitor.
That's the one. Yeah, just seemed like a regular guy. Worked as a janitor at a gas station. Nothing out of the ordinary, you'd think. But when he passed away, it turns out he'd quietly built up this $8 million fortune.
8 million. Wow, seriously.
Seriously. And get this, no lottery win, no big inheritance. It was just consistent saving and investing. Solid blue chip stocks over decades.
That's incredible.
It really is. And here's the kicker, the core insight right away.
Yeah.
It wasn't about genius-level intelligence or some high-flying job. It was the consistency, the long-term action.
So sticking with it was the key.
Yeah. Fewer than 4,000 people who died the same year had that kind of net worth. A janitor was one of them. It just makes you rethink everything we assume about financial success, doesn't it?
It absolutely does. Ronald Reed's story, it's a perfect illustration of the central idea we're exploring, that thriving financially isn't always about some secret formula or complex market knowledge.
Right.
So often it's deeply tied to our individual psychology, the habits we form, the way we see money.
Exactly. And that leads us straight into our first big area, the power of our personal history. We all see people doing things with money that just look, well, crazy, right?
Oh, definitely. You see it all the time.
But as our sources point out, nobody's actually born financially illogical. Our perspectives on money, like what feels normal, what feels risky, what we prioritize, it's all molded by the specific stuff we've lived through.
And what's fascinating is just how incredibly different those experiences can be. I mean, think about it.
Yeah.
Someone who grew up, say, during a time of really high inflation, their gut reaction to debt, to investing, it's going to be fundamentally different from someone who's only ever known relatively stable prices.
Completely different worldview.
Totally. And our upbringing, that plays a massive role, too. The lessons you learn about money in a household that's, struggling to make ends meet, worlds apart from the lessons in a wealthy banker's family.
And then there's just plain luck, right? The luck of when and where you were born, the economic climate when you started working.
Exactly. All those random factors.
It's like this tiny, tiny sliver of our own lives, maybe, what, 0.0000001% of everything that's happened in the world.
Yeah, something ridiculously small.
But it ends up having this huge, like maybe 80% influence on how we think money actually works. That idea from our sources, it's kind of mind-blowing when you stop and think about it.
It really is, and explains so much, doesn't it? Like why people with similar intelligence levels can have such radically different views on everything from, recessions to the best way to invest.
Or even just how much risk feels okay.
Right. Our own personal histories create these really strong, often unconscious anchors in our minds. They shape our intuition about finance.
Okay, consider this contrast. Frederick Lewis Allen wrote about the Great Depression, saying it left this deep inward mark on millions of Americans, scarred them financially.
A whole generation profoundly affected.
But then you have someone like John F. Kennedy. His family was incredibly wealthy. When someone asked him later about his memories of the Depression, he basically admitted his family's wealth grew during that time.
Wow. So a totally different reality.
Totally. His direct experience was like hiring extra gardeners just to give people jobs. He didn't truly get the widespread suffering until he read about it years later.
It just hammers home how hard it is to really, truly understand an experience you haven't lived through yourself.
You just can't, can you? Reading stats about unemployment or market crashes, that's one thing.
Right. But feeling that deep, gnawing uncertainty, the fear of not being able to provide for your family, that shapes you in a way that, well, a spreadsheet just can't capture.
Spreadsheets model the past, but they miss the feeling.
Exactly. They miss the scars.
And this isn't just, interesting stories. Economists have actually dug into this. There's research by Ulrike Malmendier and Stefan Nagel.
Oh, yeah, their work is
They
fascinating.
looked at decades of data, right?
Yeah.
And basically found that people's investment choices, like over their whole lives, are heavily anchored to the economy they experienced when they were young adults.
So those formative years really stick.
Massively. If you came of age with high inflation, you were less likely to put your money in bonds later on, compared to someone who didn't have that experience.
And the same for stocks, right? Good market early on meant more stocks later.
Exactly. Growing up with a strong stock market often led to investing more in stocks down the line.
And what's really striking about their findings is that this personal history seems to be a better predictor of, like, how much risk someone's willing to take than things we normally focus on.
Like what? IQ,
How you-
education.
Yeah, exactly. More predictive than IQ or education level, or even how much they technically know about finance. Sometimes it really is just the dumb luck of when and where you were born, as one source put it. That plays a surprisingly huge role.
It reminds me of Bill Gross, the bond king. He reflected on how his whole career basically coincided with this huge multi-decade fall in interest rates.
Right, a massive tailwind for bond investors.
So naturally, that shaped his view of bonds as these amazing wealth-generating machines. But his father's generation, they lived through higher inflation. Their view of bonds would have been totally different.
Worlds apart. It really drives home how these specific historical windows shape the financial mindset of entire generations.
Think about even more extreme examples like World War II. The U.S. stock market actually did pretty well during the war overall.
Yeah, surprisingly resilient.
But the stock markets in Germany,
Right.
Japan, absolutely devastated, wiped out.
Total destruction.
So imagine living through that. How could those wildly different experiences not create fundamentally different lifelong perspectives on investing, on risk, on economic stability?
You just can't compare them.
And it's not just these huge global events either. Even smaller individual economic realities shape views. Our sources mention someone in a developing country who actually preferred working in a factory.
Which many in the West might see as exploitative.
Right. But for her, it was better than the even harsher traditional forms of exploitation common in her community. It just highlights how your starting point totally changes your perception of opportunity, of fairness.
It all circles back to this key idea, doesn't it?
Yeah.
Every financial decision, no matter how bizarre it looks from the outside,
Yeah.
it makes perfect sense to the person making it in that moment, based on their own unique mental model of how the world works, a model built piece by their own life.
Okay, so our personal journeys shape our view. But what about those outside forces, the ones we can't control? Let's talk about luck and risk.
Yes, luck and risk. It's interesting how our experiences can make us either more or maybe less willing to even acknowledge their role.
Definitely. Our sources really stress how intertwined they are and how they play a much bigger part in our financial outcomes than we usually admit.
They're like two sides of the same coin, aren't they? These forces, mostly beyond our individual effort, that massively influence where we end up. Scott Galloway nailed it. Nothing is as good or as bad as it seems.
That really captures it. That quote resonates.
It does. It accounts for both the lucky breaks and the unlucky hits.
Okay, Bill Gates again. Perfect example. The story of him ending up at Lakeside, one of the very, very few high schools in the late 60s that even had a computer.
Yeah, that's the definition of 1 in a million luck, right?
Exactly what our sources call it.
Yeah.
And Gates himself admits it. He said, without Lakeside, there might not have been a Microsoft.
Incredible. But then you have to consider the flip side. Kent Evans.
Gates' friend from Lakeside.
Yeah, apparently just as smart, just as driven, shared the same ambitions. But he experienced the opposite, that 1 in a million risk.
The mountaineering accident.
Right. Tragically died before they could even get started. It's just this stark reminder of the counterfactual Evans could easily have been a co-founder of Microsoft.
Wow. Same force, luck, and risk just pointing in opposite directions with drastically different outcomes.
Exactly. And it's just so hard for us as humans to really internalize the role of both, especially with money.
We have biases, right?
Big time. We tend to look at other people's failures and think, oh, bad decision. But when we fail, just bad luck.
Yeah, guilty is charged sometimes. It's a natural instinct.
It is. And the media often doesn't help. Think about Forbes, Fortune. They celebrate these heroic billionaire investors.
The geniuses.
Right. But they might totally gloss over the role that pure dumb luck played in getting them there. And at the same time, they ignore maybe smarter investors who just got hit by bad luck.
So the picture we get is skewed. Makes it hard to learn the right lessons.
Totally skewed. We end up focusing on the extreme outliers, the winners, without seeing the whole picture, including all the failures and the role chance played.
Our sources even bring up someone like Cornelius Vanderbilt. Huge success, built an empire.
Yeah, but his methods were incredibly risky, borderline reckless sometimes. His famous line, "What do I care about the law? Ain't I got the power?"
Right. It just highlights that razor-thin edge between being bold and brilliant and being just plain reckless, especially when risk isn't properly factored in.
And even Benjamin Graham, the father of value investing, Mr. Diversification.
His own success largely came from one bet.
The vast majority, yeah. A super concentrated bet on JICO. It kind of seems to contradict his own core principles.
So where is the line between bold and reckless? It's blurry.
It's incredibly blurry, which is why maybe studying the average outcomes, the more typical experiences, is more useful than just focusing on these extreme cases.
Bill Gates, again, had a great quote on this. Success is a lousy teacher. It seduces smart people into thinking they can't lose.
Ooh, that's good. Hits the nail on the head.
It's that crucial reminder, right? Acknowledge the luck that got you there, but always be aware that risk can turn the tables in an instant.
And failure can be a lousy teacher too, can it?
How so?
Well, it can make smart people think their perfectly reasonable decisions were terrible just because they ran into bad luck, the downside of risk. It's so important to have some self-compassion, you know? Cut yourself some slack when evaluating failures.
Because nothing is ever quite as good or as bad as it first seems.
Exactly. Which, interestingly, brings us to this idea of, well, enough.
Enough. Such a simple word, but so loaded. John Bogle, the Vanguard founder, told this great story about Kurt Vonnegut and Joseph Heller.
Oh, I think I know this one. At the Billionaires Party.
That's it. Vonnegut points out that their host made more money in a single day than Heller ever got for writing Catch-22.
A classic novel, yeah.
And Heller just replies, yes, but I have something he will never have. Enough.
Wow. Just
Yeah.
perfect. It speaks volumes, doesn't it? That internal sense of contentment, knowing when to stop chasing.
It really does. Recognizing that point where more stuff doesn't actually add more happiness or well-being.
It's about that internal benchmark, not just constantly comparing yourself to others. Yet we see so many examples, don't we? People with unbelievable wealth.
Still pushing for more.
Still pushing, still taking massive risks, sometimes even breaking the law.
Like Rajat Gupta, on the board of Goldman Sachs, already incredibly wealthy.
And gets involved in insider trading. For what seemed like, relatively speaking, not a huge amount compared to his existing fortune.
Or Bernie Madoff. He had this legitimate, hugely successful market-making business. He was already incredibly rich.
And still builds this massive Ponzi scheme on top of it. It just makes you scratch your head, right? Why? Yeah. What drives someone who already has so much to risk everything?
It's like the pursuit itself becomes the goal.
Exactly. There's this disconnect between the objective number, the amount of money, and that subjective feeling of having enough. Maybe it's envy. Maybe it's just the game itself. But it shows how the chase can become detached from any real need or purpose.
Detached from providing security or freedom, which is maybe the original point.
Right. Which leads us nicely into another powerful but often background force, compounding.
The eighth wonder of the world, as Einstein supposedly called it.
Whether he said it or not, the power is real. Our sources use this really cool analogy, Milutin Milankovitch's theory about ice ages.
How does that relate?
Well, he figured out that these tiny, almost imperceptible long-term shifts in the Earth's tilt, over tens of thousands of years, could cause massive global climate changes, ice ages.
So small changes adding up over immense time create huge results.
Exactly. It's a great way to visualize compounding. It's not usually dramatic in the short term, but over long stretches, it's incredibly powerful.
And then there was another layer to that, right? Köppen's discovery.
Yeah, Vladimir Köppen refined it. He found it wasn't just the super cold winters causing the ice ages. It was actually moderately cool summers.
Cool summers. How?
Because the cool summers meant the previous winter's snow didn't completely melt. So a little bit was left over. Year after year, it builds up, reflects more sunlight, cools things further, this gradual snowball effect.
Ah, I see. It emphasizes the gradual, often overlooked nature of how compounding works. It's not instant magic.
Precisely. And this mirrors investing perfectly. Warren Buffett is the poster child, isn't he?
Absolutely. His incredible wealth is mostly down to time, right?
Hugely. Our sources point out the vast majority of his net worth was accumulated after he turned 50. Even after he turned 65.
So his secret isn't necessarily hitting grand slams every year.
No, I mean, he's obviously a brilliant investor, but his real superpower is time. Decades and decades of letting those returns compound.
The numbers are crazy, aren't they? Like, if he'd stopped in his 60s,
His net worth would be something like 99.9% less than it is today. It's staggering. It just highlights the sheer power of a long time horizon.
and it's not even about having the absolute highest returns each year. Look at Jim Simons.
From Renaissance Technologies.
Yeah.
Yeah, his average annual returns are actually way higher than Buffett's. Phenomenal numbers.
But his net worth is lower. Why?
Simple. He started later. He hasn't had as many decades for those incredible returns to compound.
If he had started as early as Buffett,
The numbers become astronomical, almost meaningless. They're so big, it just drives home the point. Time is arguably the most potent variable in compounding.
so why isn't this more intuitive? Why do people chase short-term gains instead?
Because it's slow, it's not exciting. Compounding is like watching paint dry or grass grow. We overlook its potential because it doesn't provide that instant gratification.
Nobody writes books called "This Guy Invested Consistently for 75 Years."
Exactly, it's not a sexy story. Analysis of Buffett often focuses on his stock picks, his genius, but maybe underplays the simple endurance.
So good investing, as the sources suggest, isn't about those unsustainable high returns.
It's about getting pretty good returns that you can stick with for a really, really long time, letting that compounding magic happen.
Which leads perfectly into the next crucial point: the difference between getting wealthy and staying wealthy.
Ah, yes, two very different skill sets.
Our sources use that stark contrast from the 1929 crash. Jesse Livermore, the famous speculator.
Made a fortune betting on the crash, right? Became one of the richest men alive overnight.
Yep. And then Abraham Germansky,
Hmm.
a real estate developer, I think.
Okay.
Totally wiped out by the same crash.
A dramatic contrast. But what's the deeper point?
Neither of them managed to stay wealthy. Livermore eventually lost it all, ended tragically. Germansky was ruined and basically vanished.
So making the money is one thing. Keeping it is another game entirely.
Exactly. Their stories hammer home that getting wealthy requires taking risks, maybe being optimistic, maybe being bold. But staying wealthy, that requires a different mindset. It requires humility and fear. Fear of losing what you've gained.
Yeah.
Our sources argue that if you boil down long-term financial success to one word, it's survival.
Survival, just staying in the game.
Right. Being able to endure the inevitable downturns, avoiding those catastrophic losses that take you out completely.
The statistics back this up, don't they? How many companies fail over time? The turnover on rich lists.
Exactly. A huge percentage of public companies eventually lose most of their value. The Forbes 400 list sees massive churn every decade. Staying at the top is hard.
Michael Moritz from Sequoia Capital had a great take on this. He said their long-term success comes from this constant underlying fear of going out of business, never getting complacent.
It's like tending those oak trees we talked about with compounding. You need decades for amazing results, but you have to survive all the droughts, storms, and pests along the way.
So survival is the prerequisite for compounding to work its magic over the long haul.
It's not just about maximizing gains. It's equally, maybe more, about minimizing losses, avoiding ruin. What Buffett didn't do is just as important as what he did. He didn't get wiped out.
Nassim Taleb put it bluntly, having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
That survival mindset, it means prioritizing being financially unbreakable, because that's what allows you to stick around long enough for the good stuff, the compounding, to happen.
Which often means doing things that seem counterintuitive in the short term, right?
Like holding cash during a raging bull market. Feels wrong. Feels like you're missing out.
But that cash is your lifeline. It's your buffer, your flexibility when things inevitably go south.
And it all points to the need to plan for the unexpected. Our sources have that great line, plan on the plan, not going according to plan.
Love that. Because the future is always uncertain. Always. 9/11, the 2008 crisis, a global pandemic. Nobody sees these things coming with perfect clarity.
So a good plan isn't one that predicts the future perfectly. It's one that accepts uncertainty, one that has room for error built in.
A margin of safety.
Exactly. And that margin of safety isn't just one thing. It can be a frugal budget, flexible thinking, loose timelines, anything that gives you breathing room.
It's about being okay, or even happy, with a range of outcomes, not just pinning your hopes on one perfect scenario.
And it's not just about being conservative, is it? It's about increasing your odds of success at a given level of risk simply by improving your chances of survival.
Right. staying in the game long enough to let the odds work in your favor. Now let's shift gears a bit and talk about something interesting. Our attraction to pessimism and how we often underestimate growth.
Okay, pessimism. Why are we so drawn to bad news?
Our sources use this neat analogy. Imagine a parent checking their baby's brain scans every morning and seeing fewer synaptic connections than the day before.
They'd panic, think something's wrong, right?
Exactly. They'd see it as loss, as regression. But actually, it's a normal part of brain development, pruning weaker connections to strengthen the important ones. Growth often involves some form of loss.
So economies, markets, careers, they follow a similar path. Growth happens amidst setbacks and losses.
Often, yes. Progress isn't usually a smooth upward line. Brad Pitt had a quote about his movie projects. Some work and some don't. There's no reason to belabor either one. Just get on to the next.
Acceptance of failure is part of the process.
Right. Look at Heinz Bergerun, the famous art dealer. Apparently he showed little promise in his youth, but became hugely successful later. Success often blooms late, after many unremarkable seasons.
It feels counterintuitive, though, doesn't it? Success despite frequent failure, we underestimate how normal failure is.
We really do. And we overreact when it happens. Think about Walt Disney's early days. His first studio, bankrupt. Many early cartoons, lost money.
Until Snow White.
Exactly. Snow White was this massive, transformative success that dwarfed everything before it. One huge win compensated for many losses.
That sounds like the venture capital model. Most startups fail. A tiny few deliver huge returns.
Precisely. But here's the kicker. Our sources show that this pattern isn't just for startups. It's remarkably similar even in the broad public stock market, like the Russell 3000 index.
Really? Even with big established companies?
Yeah. A surprisingly large chunk, maybe 40% of companies in the index at some point lost 70% or more of their value and never really recovered. They were effectively failures as long-term investments.
Wow, 40%. That's huge.
It is. And meanwhile, most of the overall market return comes from a very small percentage of superstar companies, maybe only 7%, that vastly outperform the average.
So most stocks are duds, and a few are spectacular winners.
Basically, yeah. Even within established industries, failure rates are significant. This really changes how you should think about investing, doesn't it?
How so? What's the takeaway for an individual investor?
It suggests that maybe your day-to-day decisions, tweaking your portfolio constantly, matter less than how you behave during those rare critical moments. You know, the 1% of the time when panic or euphoria takes over the market.
Like the pilot analogy. Hours of boredom punctuated by moments of sheer terror.
Exactly like that. Investing is often long periods of waiting, punctuated by these crucial moments where keeping your head is paramount.
So an investing genius isn't someone who's always right.
Maybe it's someone who can just do the average sensible thing when everyone else is going crazy, staying calm, sticking to the plan.
Because even the best investors fail often. George Soros said, it wasn't about being right or wrong, but how much you make when you're right versus how much you lose when you're wrong.
That's the key. The magnitude matters more than the frequency. Okay, let's switch focus again. What's the real value of money? Beyond just buying stuff.
Control, right? Flexibility.
That's what our sources argue is the highest dividend money pays. The ability to do what you want, when you want, with who you want, for as long as you want. Control over your time.
There's research on this, isn't there? Angus Campbell.
Yeah, the psychologist Angus Campbell found that having a strong sense of control in your own life is a way more powerful predictor of happiness than things like your salary, house size, or job title.
That feeling of autonomy.
Exactly. Money's greatest intrinsic value might be its ability to give you control over your time, to give you independence.
Think about what that means in real terms. Leaving a job you hate.
Yeah, or taking time off to be with family. Or retiring when you decide, not when circumstances force you to.
Our sources share that personal story about the host's investment banking internship. High pay, prestigious.
But utterly soul-crushing because of the lack of control over time.
Right. The money wasn't worth the loss of autonomy. It highlights that trade-off.
And it's interesting how work has changed. Median incomes are up since the 50s, sure. But do we feel more in control of our time? Maybe not.
Why is that?
Well, for many knowledge workers, the lines are blurred now, aren't they? You can technically clock out, but your brain might still be churning on work problems 24/7.
Yeah, the always-on culture.
It's different from, say, a 1950s manufacturing worker who punched out and was truly done for the day. Our sources even compare modern work sometimes to John D. Rockefeller's deliberate inaccessibility or thinking is the work, and that can feel constant.
Which brings us to another psychological trap. Chasing wealth for external validation. Wanting people to admire you because of your stuff.
Ah, the fancy car effect. Our sources nailed this one. When you see someone driving a Ferrari, what's the first thought?
Usually something like, wow, if I had that car, people would think I'm cool.
Exactly. It's rarely, wow, that driver must be an amazing person. We use their wealth as a benchmark for our own desire for admiration.
It's a paradox, isn't it?
Hmm.
People chase wealth, hoping others will like and admire them, but others just see the wealth and use it to fuel their own desires.
The host's valet story illustrates this perfectly. Driving these amazing cars, but wondering if the owners even noticed the fleeting admiration for the car, or if they were just thinking about how the car made them look.
And it applies to everything, right? Big houses, jewelry, fancy clothes.
All of it. The underlying message. True respect, genuine admiration. That usually comes from things like humility, kindness, empathy, not horsepower or square footage.
Which ties directly into understanding the difference between being rich and being wealthy.
Crucial distinction. Our sources define rich as current income. It's often visible the nice car, the big house.
But wealthy is different.
Wealth is the income you don't spend. It's the savings, the investments. It's largely invisible, hidden.
That's why it's easier to spot rich people, but much harder to identify truly wealthy people. We see the spending, the richness, we don't see the assets, the wealth.
Think about your quiet neighbor. Drives an old car, lives modestly. Could be secretly wealthy, right? Through years of saving.
While the person with the flashiest car might be drowning in debt.
Exactly. Appearances are deceiving. And this hidden nature of wealth makes it harder to learn from. How do you emulate something you can't see?
It's like trying to learn writing without reading great authors.
Good analogy. The world is full of modest-looking, wealthy people and rich-looking people on the verge of insolvency. You just can't always tell from the outside.
So if wealth isn't about high income or flash, what is it about?
Savings rate. Our sources argue, pretty convincingly, that building wealth has surprisingly little to do with your income or investment returns.
And almost everything to do with your savings rate.
Right. Think about the 1970s oil crisis again. We thought we were running out of oil. The solution wasn't just finding more oil.
It was efficiency, right? Using less,
Well,
conservation.
Exactly. We learned to do more with less energy. Saving is the personal finance equivalent of energy efficiency. It's the variable most within our control.
Wealth is just what's left over after spending. Simple, but profound.
And you absolutely need a decent savings rate to build wealth, no matter your income. You can earn a fortune and have nothing left if you spend it all.
Plus, the value of wealth is relative anyway, isn't it? Relative to your own needs and expectations.
Totally. Which brings us to flexibility and being, well, reasonable. In today's world, being smart isn't enough.
Competition is global now. Technology connects everyone.
Exactly. The talent pool is vast. So just being intelligent doesn't guarantee success like it might have in the past. Flexibility, adaptability, those are becoming more valuable.
Which comes back to having control over your time and options.
Which comes back to saving. Saving gives you that flexibility.
And this leads to the idea of aiming not for coldly rational financial decisions, but for being pretty reasonable.
Yes. This is so important. We're human. We have emotions. Trying to be perfectly rational all the time is unrealistic, maybe even counterproductive.
Because you won't stick with it.
Probably not. Being reasonable means acknowledging emotions, real-world constraints, social factors. It makes strategies more sustainable.
Our sources had that wild example of Julius Wagner-Jauregg and malaria therapy for syphilis.
Yeah, seemed totally crazy giving people malaria. But his pattern recognition, his willingness to try something unconventional based on observation was reasonable in context, even if not purely rational by standard medical thinking at the time. And it worked. He won a Nobel Prize.
It's like fighting fevers. We know fevers help fight infection, scientifically.
Right. There's evidence for their benefit.
But we all take medicine to lower them. Why? Because they feel awful.
Exactly. Emotional discomfort overrides the purely rational path. Same often happens with money.
Even Harry Markowitz, Mr. Modern Portfolio Theory himself. His own initial portfolio wasn't some complex optimization.
No, it was a simple 50-50 split, stocks and bonds. Why? He admitted it was basically to minimize future regret.
Reasonable. Emotionally sound for him. but not strictly the most rational allocation according to his own theories.
It shows investing isn't just math. It's social. It's emotional. Decisions happen in the real world.
You see advice that's technically true, but contextually nonsense, right? Like telling a young retiree to use high margin. Mathematically optimal on paper, maybe.
But practically insane, way too risky emotionally and financially for most people in that situation.
So being reasonable might mean choosing investments you actually love or understand, even if they aren't perfectly optimal on a spreadsheet.
Because that emotional connection makes you more likely to stick with them when things get tough. That endurance is key.
Or things like home bias favoring investments from your own country, or even doing a tiny bit of day trading just for fun, if it keeps you engaged with your main sensible strategy.
Right. These aren't rational in a pure finance sense, but they can be perfectly reasonable parts of a broader, sustainable approach. Even John Bogle said he sometimes made financial decisions for family reasons that weren't strictly by the book. It's about being human.
Okay, let's talk about history and predicting the future. Scott Sagan said, things that have never happened before happen all the time.
Great quote. History is full of surprises. And yet, in finance and economics, we lean so heavily on history as if it's a perfect map of the future.
Which is ironic because these fields are driven by change and innovation.
Exactly. It's the historians as prophets fallacy. Trying to use past data to predict the future in fields defined by uncertainty and human behavior. It's not like geology or physics, where the underlying laws are constant.
So just because someone has decades of experience doesn't mean they can predict the future better.
Not necessarily. Experience can sometimes lead to overconfidence, a belief that you've seen it all before, but the context always changes.
Michael Batnick made that point about rising interest rates the last time we saw a sustained rise was so long ago in such a different world that past experience might not be a useful guide at all.
Right. And think about the drivers of history. Unpredictable events, single individuals. Hitler, Stalin, Mao, Gates. Inventions like the internet, antibiotics.
Tiny fractions of people or events cause massive shifts.
Totally disproportionate impact, which makes predicting major economic shifts based on past patterns almost impossible. Those random, unpredictable events are often the biggest drivers.
And surprises will likely continue to be the biggest drivers of change.
Almost certainly. Plus, history itself can be misleading because the structure of the world changes. Think about retirement savings. 401ks, Roth IRAs, they're relatively recent inventions. They fundamentally altered the landscape.
Or even the long gap we had between major recessions recently. The nature of cycles can change.
Exactly. Even classic books like Graham's The Intelligent Investor. Graham himself later admitted that some of his specific formulas became less relevant as the market evolved. He moved away from elaborate stock analysis.
So that phrase, it's different this time. Maybe sometimes it is different.
While it's often used mockingly, the reality is the world does change. And those changes, those differences are often what matter most. Which brings us back, yet again, to room for error.
The ultimate safety net. Because you can never, ever be certain enough to bet everything. The world isn't consistently kind.
That card counter, Kevin Lewis, made the point beautifully. Even with a clear statistical edge, you need enough capital to survive the inevitable runs of bad luck. Otherwise, the edge is useless.
Good ideas taken too far become bad ideas.
Precisely. And we constantly underestimate how much room for error we need. Analysts give precise price targets, not ranges. Forecasters use exact numbers.
Max Bazerman's research on home renovations. People massively underestimate costs for their own projects, but are more realistic about other people's. We're overconfident about ourselves.
And there's emotional room for error, too, right? The gap between what your spreadsheet says you can technically withstand and what you can actually tolerate emotionally, especially with family involved.
That's huge, particularly for retirement planning. Future returns are uncertain. Using conservative estimates builds in that crucial buffer.
Like the host's personal strategy, assuming future returns will be a third lower than history suggests, it's a margin of safety.
Charlie Muger's advice. The best way to achieve felicity is to aim low. Manage expectations.
Another approach is the barbell strategy. Take some calculated risks, but keep a large chunk incredibly safe. Protect the downside.
Because the ability to do what you want when you want that infinite ROI needs protecting above all else. Room for error protects you against the things you can't even imagine.
And we also need to expect ourselves to change. Our goals, our desires, they aren't fixed.
Yeah, think about life changes. People switch careers, relationships change, priorities shift. What you wanted at 20 is rarely what you want at 40 or 60.
Long-term financial planning is vital, but it has to acknowledge that you will change, just like the world will change.
It's that end of history illusion again. We underestimate our own future evolution. Daniel Gilbert's work on this is fascinating.
We think we've arrived at our final selves, but we never have.
So the advice is to avoid extremes in planning. Don't sacrifice everything today for a future you might not want, but don't ignore the future either.
Aim for balance at every stage. It increases endurance and reduces potential regret. And be willing to change your mind, especially about big decisions made when you were young, like careers.
Like Daniel Kahneman being willing to totally rethink his own ideas. That intellectual flexibility is key.
Absolutely. Okay, last couple of big ideas. First, the price of investing. Not dollars, but emotions.
Volatility, fear, doubt, uncertainty, regret. That's the cost of admission for potential returns.
Exactly. And if you don't recognize it as a price you have to pay, you end up trying to get something for nothing.
Like trying to steal the car instead of buying it.
Good analogy. You try to get the returns without paying the price of volatility, it usually doesn't work.
Volatility is the fee for potential market returns. Look at great stocks like Netflix or Monster Beverage. Huge winners long term.
But they spent huge chunks of time trading way below their previous highs. You had to endure massive drawdowns, pay the price to get the long-term gains.
And things like tactical mutual funds that promise returns without the volatility, they often fail.
Or companies that try to smooth earnings artificially, like GE under Welch or Fannie and Freddie. It creates an illusion, but reality eventually bites back.
So reframe volatility. It's not a fine for doing something wrong. It's the fee you pay for potential growth, like a Disneyland ticket.
Right. You pay the fee, you get the potential ride. Higher potential returns generally come with a higher fee of volatility. You just have to convince yourself the fee is worth paying.
Our sources also touched briefly on bubbles, the dot-com bust, the housing crisis. Incredibly destructive.
And so hard to learn from, right? Because they're controversial, hindsight bias kicks in, people just want to blame someone.
But the interesting point was that behavior inside a bubble can seem rational short term, like day traders chasing Yahoo in '99.
For their short time frame, maybe it made sense. Money chases returns. Momentum builds. Short-term traders pile in.
Not everyone in a bubble is irrational. They might just be playing a different game with different rules and timelines.
And rising prices themselves are dangerously persuasive. They can suck in even cautious investors who fear missing out. It links back to social proof, too, seeing others get rich.
Okay, let's revisit pessimism one last time, more broadly. Why is bad news so seductive?
Remember that Russian professor predicting the U.S. would break apart by 2010?
Wildly pessimistic.
Oh,
And it got front-page news coverage.
exactly. Imagine an equally optimistic prediction getting that kind of attention. Unlikely. Pessimism just grabs us more.
Think about post-WWII Japan. Utter devastation.
Yeah.
Who would have predicted the economic miracle that followed? Pessimism seemed far more rational then.
And yet, look at financial commentary. Often leans pessimistic, despite the market's long-term upward trend.
Matt Ridley said pessimism is often favored over optimism, regardless of facts. Hans Rosling found people think the world is way worse than data shows.
John Stuart Mill noted ages ago, the guy who despairs when others hope is often seen as the wise one, the sage.
Why, though? What are the reasons?
Well, money affects everyone, so bad financial news gets attention. Also, pessimists often just extrapolate current bad trends linearly.
Without accounting for adaptation and innovation, like the peak oil predictions getting foiled by fracking.
Right. Threats incentivize solutions. Pessimists often miss that dynamic feedback loop. Progress is harder to see. Setbacks are immediate and vivid.
Even the Wright brothers' first flight. Initial reaction was mostly disbelief, disinterest. Only later, often spurred by negative events like crashes, did interest really take off. Bad news travels faster and seems more urgent.
Exactly. Pessimism often feels smarter, more compelling in the moment. Optimism requires a longer view, more faith in unseen progress.
Okay, final section.
Yeah,
The alien analogy. Arriving in 2007-2009, seeing surface similarities, Times Square parties.
But completely missing the narrative shift, the sudden loss of faith in housing prices that triggered the crisis.
It shows how much the stories we tell ourselves matter. Those invisible narratives drive behavior. And desperation makes us believe almost anything, right? Like that story of the father in Saudi Arabia and the fake medicine.
When stakes are high and information is limited, we grasp at straws. It helps explain why people follow bad financial advice or fall for schemes like Madoff's. The desire to believe is overwhelming.
Which brings it all back to room for error, flexibility, independence. These are the buffers against desperation and bad decisions driven by narrative.
Even the Fed's forecasts were way off in 2008. Predicting complex systems is incredibly hard. Nobody has the full picture.
Policymakers might even hesitate to predict bad news because the prediction itself could make things worse.
So the ultimate conclusion, room for error is maybe the most powerful force in finance. Because nobody knows everything. We all have incomplete views, but we build complete narratives to cope.
Like a toddler making sense of the world.
Exactly, and that's why we crave forecasts, even inaccurate ones. They give us a sense of control in an uncertain world. But finance isn't astrophysics. It's messy, human, unpredictable.
So, like the alien, we think we understand based on what we see. But we might be missing the crucial internal narratives driving everyone else.
Precisely. We don't know what game other people are playing.
Wow. Okay, so bringing this all together, it's a complex picture, isn't it? Our financial lives are shaped by this deep interplay of personal history, luck, risk.
Our definition of enough, the slow burn of compounding, the need for survival, room for error.
The economy changing, the value of control, the stories we tell ourselves. It's all in there.
And the big takeaway really is how subjective it all is. What works for one person based on their unique journey might be totally wrong for someone else. And that's okay.
It really is. I was thinking about my own family, how my parents' experience going from having very little to being comfortable financially made them incredibly frugal and value independence above almost everything else.
And that shaped you.
Definitely. That focus on saving, on autonomy over your time, it sticks with you.
And as our sources showed, achieving that independence, it's often more about managing expectations and saving consistently than earning some crazy high income.
Absolutely.
Yeah.
My own approach now leans towards simple index investing, long-term view. But that's just what fits my psychology and my goals. Not the only way.
Right. And maybe that's the final thought for everyone listening. Understanding the psychology of money. It isn't about finding the one right answer or some secret formula.
What is it about then?
It's about gaining awareness, understanding why you make the decisions you do, and then consciously aligning those decisions with your own personal goals, your values.
But ultimately, what helps you sleep at night?
Exactly. What helps you sleep at night? So maybe take some time this week, reflect on your own financial story. What experiences have really shaped your views on money? It's a deep dive worth